Welcome everybody. This is George Veter Financial. We're well into now the second quarter of the year, and there's been some things develop in the market that I thought were worthy of a quick conversation that hopefully give you more clarity on where we're at and why we're doing what we're doing to weather this bit of an economic storm we've been in since the first of the year. First of all, we can celebrate a very solid week last week. The S&P was up about 6.6% for the week. And we finished the month of May about flat, which is, we'll call that a win. We had 7 really brutal weeks of negativity and selling that was kind of hard on everybody's psyche. And then we had buyers come back in when the S&P dipped into bear market territory, which is defined by a 20% drop from the previous high. There are some pinholes of light in the worry points that we've already framed for you. And by way of reminder, the 3 things the market's the most concerned about is A, the COVID situation in China, exacerbating the supply chain issues that are helping to support inflation pressure. B, the war in Eastern Europe with Ukraine and Russia. And C, the Fed tightening cycle here that threatens to, by many economists' estimation, slow down growth, maybe even stop growth or tilt us into recession by creating a slower economy by raising rates to make money less accessible to the consumer and to businesses expanding. The stock prices that are reflected in the various public markets today are not based on headlines today. They're based on where the market sees 2 to 3 quarters down the road the environment being. So when there's uncertainty, the market will oftentimes price in worst case scenarios. And I think that's what we've seen. Tons of negativity, the market pricing in what could happen in a negative sense in all the areas that I just discussed. So as far as the market finding some equilibrium temporarily, at least temporarily, and fighting back some, is based on some encouraging signs. Whenever you have a lot of pressure to the downside, little pinholes of light where data be not quite as bad as what we had priced in, cause upward market momentum. A few things that I just want to highlight. First of all, inflation data. What the market interprets the relevant statistics and data being is that inflation appears to be peaking here and starting to ease. Now, we're a long ways from the Fed target of 2% inflation, up here at 8% year-over-year inflation with the CPI number, but we are softening that curve. And in lots of sleeves of the economies, we're off our highs with our highest price points from the past. Especially used car sales were brought up in the last Fed meeting, as well as is being 2 months off their highest prices, as well as lumber and other areas that aren't as peaked as they once were. So as supply comes up, prices moderate rather. And another thing that I think we are seeing is that consumer spending has been surprisingly resilient. We had consumer spending stay strong through April as well as May. There is a disparity with the income levels. The higher income earning Americans are, as you would guess, continuing to spend at a more robust level. And there is some shifting in the patterns of spending by the lower socioeconomic levels of Americans, where more money is put towards food and other essentials rather than services and discretionary spending rather. But the general spending per capita has been much stronger than analysts have predicted, and that's supporting continued expansion of the U.S. economy. And our earnings. We have a mixed picture of earnings. We had in the month of May, some disappointing results from companies like Target and Walmart, which caused a big sell-off in many retail stocks. But then you had Macy's and Nordstrom's as well as others that surprised to the upside. So we kind of had a mixed bag of results there. In general, though, spending's better than we thought. And then the bond environment has firmed up. Bonds were going down, which they typically do when interest rates are moving higher on new issue bonds. But the stability in bond prices and yields were even last week, and actual bond prices were up 0.9 on the ag index. So bonds that had a difficult time with the pricing in of higher rates now seem like they're supporting portfolios, and the diversified portfolio theory seems to be making more sense now, where for a minute every one of those sleeves seemed to be going down, but now we're getting the balance and the energy or the synergy of a well-diversified portfolio. Again, I want to reiterate, there's only two things that, when we have an economic storm like this, only two things that can take us out of the game and give us irrecoverable losses. One is if we panic and go to cash and miss the recovery that ultimately always has come and we believe always will come after one of these economic storms. The second thing is if we concentrate a position, if we put too much in one area and then that doesn't play well for us. Everybody else that stays properly diversified and we shorten up maturities on bonds and do the things that we can do to help us get through in a positive way this moment and make sure that we are solidly positioned for the recovery, we're all going to continue to enjoy our average returns. So just want you to know that there are pinholes of light, that there is some good news that's not necessarily focused on with the media, that we will continue to highlight for you. I'm grateful for all of you hanging tough through this moment in time, and I'm grateful for all of you communicating with me. I take calls every day, and by and large, I'm grateful for the faith in our team that our clients exhibit. And we'll continue to be worthy of that trust and do our level best to guide you forward in a way that will help you to make all of your goals realized. Thank you.